A low-cost S&P 500 fund is a solid cornerstone for any portfolio. The Vanguard S&P ETF, ticker symbol VOO or VOO, is my preferred fund for gaining exposure to 500 of the largest companies in the United States. Owning an S&P 500 fund in your portfolio guarantees that you get your fair share of the returns that America produces each year. And it's the most proven way to hedge against inflation over any long stretch of time. VOO is a major holding in my modern 3-fund portfolio that has outperformed the S&P 500 for each of the last 10 years. In this video, we will discuss why I'm holding an S&P 500 fund in a portfolio that aims to outperform the S&P 500. Let's do it. But first, if you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to build your wealth with simple, time-tested solutions. And we'll start with the basics. What is VOO? So VOO is the Vanguard S&P 500 ETF. It invests in stocks in the S&P 500 index, representing 500 of the largest US companies. Its goal is to closely track the index's return, which is considered a gauge of the overall US stock returns. And it's more appropriate for long-term goals where your money's growth is essential. And legendary investor Warren Buffett, who seems to know a thing or two about investing, you might say, over the years, is a huge believer in a low-cost S&P 500 fund. He says that it's amazing how hard people make what is a simple game. But of course, if they told everybody what a simple game it was, 90% of the income of the people that were speaking would disappear. And then he goes on later in the article to also say, consistently buy an S&P 500 low-cost index fund. Keep buying through the thick and the thin, and especially the thin. And what he means by that is we really should just dollar cost average into the S&P 500. If the market's on the rise and it's going up, dollar cost average in that week. If it's taking a dump and it's going down, definitely dollar cost average in that week. And as a general rule of thumb, we want to be greedy when others are fearful and fearful when others are greedy. A lot of people have it backwards, and I know emotions come into play and it's really hard to stay the course during hard times, but it seems like in general, from what I've seen, when the market's crashing, people are looking to sell, which really makes no sense logically if you think about it. Every time the market goes down and you put in that same, let's say $100 a week, you're buying more shares per dollar. So when the market goes down further, you want to buy more, if anything. If it goes down a little more, buy even more. But at the minimum, at least continue to dollar cost average in, whether it's going down or up. If you dollar cost average in over any 20-year stretch, you will not lose money. At least you haven't over the last 100 years, and you very likely won't in the future. VOO is made up of 500 companies, and normally you'll notice that it has anywhere from 504 to 508 holdings at any one time. And that's just because some of the companies have multiple share classes, but really there's 500 total companies that roll into this index. And VOO has a razor-thin expense ratio of 0.03%. So it doesn't cost you a lot to have this passively managed ETF making money for you long term. You'll pay $3 a year for every $10,000 you have invested. And I understand that it is tempting to handpick the best companies within the 500. So instead of buying this index, instead of buying this ETF, why wouldn't you just buy Apple and Microsoft and maybe Tesla and, insert whatever companies you believe in? But if you do that, you're taking a lot of risk, because if one company goes under, whether it's completely going into bankruptcy or just underperforming, it'll find its way out of the S&P 500. If you put all of your money into that company, you're going to go down with the ship. And see what happens when you buy the ETF, there's companies that are being added to the S&P 500 and leaving the S&P 500 every single year. In fact, let's take a look at the last 10 years of how many companies have come and gone from this index. So as you can see here, this is how many new companies have been added to the S&P 500 each year over the last 10 years. And starting at the top left here, so far in 2023, and we're about halfway through, there's been 6 additions. And keep in mind, anytime a company is added, another company drops from the index. So in 22, you can see 16 companies were added. In 21, we had 17 new companies. In 2020, 15. In 2019, there were 20 new companies. 2018, there were 15. 2017, there were 23. 2016, there were 22. Quite a bit of turnover in those years. 2015, 20. And 2014, there were 8. So if you look, 162 companies have been added to the SP 500 just in the last 10 years. And now what this means, if you were to have picked those individual companies, 162 of them are no longer in the index. Now again, that doesn't mean they're all bankrupt, but they probably have not performed well compared to the index itself. So the easiest way to do this 100% hands-off is just dump money into a ticker like VOO. And we'll talk about exactly how to do that at different brokerages in future videos. But I just want to provide the basics of when you buy the whole basket, you get all the new additions, you get rid of the ones that drop, it's all self-maintained for you. But you get that 10% return over the last 100 years for total return, or about 11% return over the last 50. So taking the good and the bad pays off long-term. And all you do is buy the whole basket, let it be passively managed, and profit in your sleep. Question 2, how is VOO managed? And as I mentioned earlier, VOO is passively managed. It seeks to track the investment performance of the S&P 500 index, a widely recognized benchmark of US stock market performance that is dominated by the stocks of large US companies. It uses a full replication. The portfolio holds all stocks in the same capitalization weighting as the index. Question 3, who should buy VOO? And a quick reminder before we dive into this one, this is not financial advice. Please always do your own research before making an investment of any kind. Normally in this section, I have to tiptoe around a little bit. I don't want to get too hyped up on a stock or an ETF that's performed well over the last few years, because you just never know if it's an individual company or it's heavily weighted towards a certain sector. Things could really change. Now in this case, I feel very comfortable speaking highly of VOO. Yes, it can go down, and there's been plenty of years where it has gone down, but I will say that it's very rare to go down 2 years in a row. It can happen, and it has before, but in general, this ETF will go up by 10 to 11% total return, so assuming dividends are being reinvested. And to answer the question more directly, I think that is a great holding for anyone and everyone. If you're really young and just starting your journey and you have a lot of years left in your career, or if you're already retired or you're approaching retirement, there's really no such thing as owning too much of VOO. The Warren Buffetts of the world are going to allocate about 90% of their portfolio to a low-cost S&P 500, with the rest going into like short-term treasuries and cash and things like that. But the point is, you really can't go wrong. There's no such thing as having too much of VOO. All right, now for my favorite part of the video, the nerdy analytics. Let's dive in and check out the return history of VOO. I've pulled up VOO on Seeking Alpha to take a look at the return history. So first things first, let's go over to the charting tab here. And I always like to add the metric of total return in addition to price return, so we can see the complete picture. With price return, for example, the last 1 year, with price return 12.7%, that is what just the price itself has gone up. So right now, VOO is at almost $403 per share, and its price has gone up 12.7%. Now the total return, which includes dividends and assumes that they're reinvested, is up nearly 15% over the last year. And if we look year to date, it's actually been really good, 15% and total return of 16%. And now if you zoom out a little over the last 3 years, the price return is 40%, total return is 46%. If we look at the last 5 years, you're at 57% price return and 72 on the total return. And zooming out 10 years, the S&P 500 has been up 162% on its price and 216.5% including the dividends reinvested. Your total return has been 216% in 10 years. That's incredible. Now I'm jumping over to the dividend scorecard because plenty of the 500 companies within VOO do pay a dividend, not all of them, but when you take a weighted average of all 500, you have a 1.54% dividend yield, which isn't too bad, and it pays you for every one share you own. In the trailing 12 months, you would have received $6.20 of dividends per share. So over the last 5 years, the dividend growth rate of VOO is 6.16%, which has outperformed inflation, which has been about 3.8% during that same timeline. So the dividends are growing faster than inflation is eating away at your purchasing power. Now we're going to check out the holdings breakdown by sector of VOO. Technology makes up 29% of the fund. Healthcare is 14, financials is 12, consumer cyclical is 10, communication is 9, and industrials is 8. Consumer defensive is 7, energy is 4, utilities, real estate, and basic material are just over 2% each. So it's a fairly balanced breakdown. Technology is high, but that seems to be the case in many ETFs and even actively managed funds these days, just because technology has performed so well over the last 10 to 20 years. And for the top 10 individual holdings, you have blue chip companies like Apple, Microsoft, Amazon, Nvidia, Alphabet, which is Google, Meta, which is formerly known as Facebook, Berkshire, Tesla, and United Health Group. And those top 10 holdings make up 30% of the overall fund, which is actually not too bad. A lot of ETFs have, 40 to 50% are their top 10 holdings. So VOO does have some good diversity, although it does have, a nice chunk of Apple and Microsoft currently, as they are huge. Apple just hit the 3 trillion market cap threshold. Now that we've checked out the return history, I always like to dive into a specific 10-year scenario as well, to show not a what if, but what actually would have happened had you been investing in VOO over the last decade. Okay, for our 10-year scenario, I'm using Portfolio Visualizer, which is a great website for doing back testing on different portfolios. Okay, so our starting year is 2014 through 2023, year to date, yes. So it's not quite 10 years, but it's almost 10 years. We're starting with an initial amount of $10,000 invested, and we're going to contribute $500 each month. We're going to assume that we reinvest dividends. We're looking at a portfolio of 100% VOO. And let's just hit analyze here. And so as we can see, the final balance of the portfolio would be $132,000. Its best year would have been 31%, and its worst year is -18, which I'm pretty sure is 2022. So here's a year-by-year breakdown of performance for total returns. In 14, we were up 13%, up a little in 15, up 12% in 16, 17 was up 22%, and then we were down 4% in 18, up 31% in 19, up 18% in 20, 28% up, 29 almost in 2021, down 18, there's that worst year, last year, and so far this year we're up 16. Like I mentioned earlier, generally speaking, when VOO has a down year, usually, but not always, the next year is up. And as you can see here, the total returns year to date are almost 17%. In the last 3 years, they were 14%. In the last 5 years, they were 12%. In the full time span, we're just about 12%. So it did outperform the historical performance of the S&P 500 slightly, but nothing crazy here. All right, I think that about does it for this video. I hope it gave you an idea of just how solid of a cornerstone VOO can be for an investor at any point in their journey. There really is no such thing as investing too much or too little into a low-cost S&P 500 fund. There's a reason that it is referred to as the market, and it is the thing that everyone's trying to beat. And frankly, over 20 plus year periods, under 10% of actively managed funds beat the S&P 500. If you like this video and you'd like to see more content like this in the future, please hit the like button, subscribe if you haven't already, maybe tell a friend, share the word about this channel. It means a lot to me and I really appreciate it. Have a wonderful rest of your day, and I will see you in next week's video. Peace.